In today's video, we're talking about the basics of investing. If you're new to investing or just want a refresher, you're in the right place. By the end of this video, you'll understand what investing is and why it's important. First off, what does it actually mean to invest? At its core, investing is simply putting your money into something with the expectation that it'll grow over time. This can be stocks, bonds, real estate, or even your own business. The goal is to grow your money faster than if you just left it sitting in a savings account. So why should you invest your money? Inflation causes the cost of goods and services to go up over time. If your money is sitting as cash, its value is being eroded, albeit slowly, by inflation. For example, if inflation is 3% and your savings account is earning 2%, you lose 1% each year in purchasing power. Historically, the stock market has returned around 7 to 10% annually, beating inflation. Now, let's talk about what you can actually invest in. The two most common investment types are stocks and bonds. When you buy a stock, you own a tiny piece of that company. As the company grows, the value of your stock can increase, and sometimes you'll even earn dividends, which are small payouts to shareholders. Bonds, on the other hand, are like loans you give to a company or the government. In return, they promise to pay you back with interest over time. Bonds are generally considered safer than stocks, but usually have lower returns. One of the most powerful concepts in investing is compounding. Compounding is when your money starts earning money, and then that money earns more money. Here's a quick example. Let's say you invest 100, and in a year it grows 10% to 110. A $10 gain. But the next year, if it grows 10% again, our 110s becomes $121, an $11 gain. The longer you leave your money invested, the bigger that snowball gets. This is why starting early is so important, even if you don't have much money to begin with. Now, let's talk about one of the golden rules of investing: diversification. This simply means spreading your investments out so you're not putting all your money in one place. Think of it this way. If you invest all your money in one company's stock and that company goes bankrupt, you could lose everything. But if you spread your money across multiple stocks, bonds, or other assets like real estate, one bad investment won't sink your entire portfolio. A great way to diversify automatically is by investing in index funds or ETFs. These are collections of many different stocks or bonds, all bundled together. When you buy into an index fund, you're essentially owning a small piece of hundreds or even thousands of companies. Another key to successful investing is having a long-term mindset. The stock market will go up and down, sometimes a lot. It can be tempting to sell when things are going badly, but that's usually the worst time to do it. Historically, the market trend is up over the long term, despite short-term drops. So try to stay calm during the dips and focus on your long-term goals. Remember, investing isn't about getting rich overnight. It's about growing your wealth steadily over time. So this all sounds great, but how do you actually start? It's easier than ever these days thanks to technology. Step 1. You'll need to open up a brokerage account. There are plenty of platforms like Fidelity or Vanguard that make it simple to start with even small amounts of money. Step 2. Choose what to invest in. If you're just starting out, index funds or ETFs are a great option because they provide instant diversification. And step 3. Start small and invest consistently. Even if you only have 50 or 100s to invest, the key is to start now and keep contributing regularly. Before we wrap up, here are a couple of quick tips. First, invest money you won't need for a while. The market is unpredictable in the short term, so only invest funds you can leave alone for at least 5-10 years. A common phrase that many people adopt is, only invest what you can afford to lose. Second, don't try to time the market. It's nearly impossible to predict when the market will go up or down. Instead, focus on regular contributions over time and let your investments grow. And that's it, the basics of investing. Hopefully, you're feeling more confident about getting started and growing your money for the future. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you don't miss out on future videos. And let me know in the comments, what's the first investment you're going to make? Thanks for watching. Have a great day.